Passive income is complete BS. And deep down inside, you know that this is true. The idea that you've got a big stock portfolio and that stock portfolio pays you dividends and you live off those dividends, it's not really reasonable. The same is true for property. Say you have multiple houses, right? And then you just live off the rent income. This also does not work. If we really crunch the numbers, if we really look at the fundamentals, passive income does not exist. At least it does not exist anymore. It might have existed in the past, but it doesn't exist anymore. So let's make a few back of the envelope calculations and then also discuss how we can potentially solve that problem, how we can still increase our lifestyle without having to work more and more hours every day. So let's start off with the numbers. Let's say you've got a house that has very high cash flow. So let's say you've got a gross rental yield, a gross rental income of 5% per annum. So you look at the value of your property and every year you get 5% of that value hitting your bank account from somebody that rents that house from you. 5% is very, very high, by the way. Now you've got cost, right? That's why it's called gross rental income. You've got taxes to pay, for example. So let's say that's 1%. You get 5% in income, 1% goes to the state. Then you've got maintenance, right? You've got repairs. You've got things that you have to upkeep, especially if tenants move. You have to do something to make the house attractive again for the next tenant. Maybe that's another 1% per year. Then you've also got agent fees, right? If you've got some kind of fluctuation and some tenant is moving out, another tenant is moving in, then you've got to pay somebody to find that new tenant. You potentially also have stamp duties, right? You have to pay the government again. That's because a new person moves into the house. So let's say that's another 1%. Suddenly, you move from 5% gross yield to maybe 2% net yield. And then we haven't even calculated what your own time might be worth, right? If you worked really, really hard in order to get that property, you probably also have a somewhat decent hourly rate and you still have management towards this, right? You still have to talk with your tenants, you still have to talk with the agents, etc. So it's not completely passive. You still have something to do. It might not be a lot, but it's also not zero. And so then the question is, if your net rental yield on your capital is say 2%, but the inflation rate on average over the decades is somewhere around 3%, a bit higher than that, 3.1, 3.2% in the US over the last decades. Really, net, you're not making any money. After all the expenses, you get 2% on your capital, but the inflation rate is 3%. In other words, you're losing purchasing power year over year. Now let's talk about stocks. Let's talk about US stocks in particular. The S&P 500 has a dividend yield of 1.1%. So for every $100 that you invest in the S&P 500, you get per annum $1.1 back in terms of dividends. Again, that's less than the inflation rate. If the price of your stocks were not to move at all, if you just bought them for the dividend, you would be losing purchasing power year after year. It hasn't always been like this, right? The dividend yield on stocks used to be more than 8%. It just went down over time. The same was true for property. The rental yields for property also used to be much, much higher. They simply came down over time. The prices of various investments rose faster than their respective income streams. So it became less and less attractive to invest. In other words, the competition among capital providers got fiercer and fiercer relative to the people that actually actively do something in order to generate the income for the capital. And so really, what does this mean fundamentally? It means that people are not buying investments for their cash flows. Their cash flows are actually negative net after inflation. The reason why people buy those properties and those stocks is just for appreciation, for price appreciation, as a hedge against monetary debasement. Now, the US dollar expands in its supply by roughly 6.8% per annum. That expansion happens through credit creation. So let's say you are buying a house and you take a mortgage. The additional money that you need for that mortgage to buy that house, that money is created out of thin air. the bank actually doesn't own that money, right? The bank doesn't own the cash in order for you to help to buy that property. The bank just creates it. That's a process called fractional reserve banking. So the bank lends out money several times to how much they actually hold. And so there's new money creation, new credit creation, and that happens at a rate of 6.8% per annum. And so that's fundamentally what's driving the nominal returns of all of those asset classes. When you look at the stock market returns, right, when you look at the very long term, people say that the S&P 500 with dividends and everything returns roughly 8 to 9% per annum. Now, the monetary expansion is 6.8% per annum. Now, very likely, you do have some costs associated with your stock ownership. If you've got an actively managed fund, the costs are relatively high. If you've got a passively managed fund, the main cost you might incur is just taxes. Still, after management fees, after taxes, you're barely beating monetary expansion. People are not buying investments anymore to make money from them. They are buying investments just to protect against this hidden tax of monetary debasement. Still, we could make the argument that when houses appreciate roughly with monetary debasement, a bit less than that, on average over the last decades, it was 4.8%, not 6.8%. But let's say we've got property appreciating in nominal terms, we've got stocks appreciating in nominal terms, and that appreciation is quicker than the consumer price index, right? It's more than 3.1%. So it seems like we earn purchasing power with those investments. But really what's going on here is just a wealth distribution from the people that do not have assets to the people that have assets. The people that do not have debt that devalues over time to the people that have debt, that have mortgages that are cheaper than 6.8% that devalues over time. So really it's the levered people with debt that are the winners of the system. And when the CPI is lower than whatever our assets appreciate with, that means we can buy more consumer goods. But what you have to understand here is that consumer goods over time just become easier and easier to produce, right? There is technological progress. It's easier today to make that TV or to create this bread, right? To bake the bread, to make all the farming, etc. All of this becomes easier over time. It needs less and less labor to produce consumer goods over time. It becomes more and more automated. And so in theory, consumer goods should actually go down in price over time. In practice, this only happens for consumer goods that have very, very rapid technological progression. Like, for example, the creation of TV sets, right? TVs used to be much, much more expensive. Now, even in US dollars, they became cheaper. But this effect actually should happen for all consumer goods long term. The reason why it doesn't happen is, again, because of credit creation, because enough people lever themselves up, diluting the monetary base. And so you also have to ask yourself, do you actually believe in the consumer price index, in the CPI? Do you believe that the 3.1, 3.2% per annum is really how much consumer prices appreciate over time? There's a lot of fudging with the data because the incentives are not necessarily aligned. The CPI is published by government agencies, and the government wants to get inflation rates, official inflation rates, very low. If officially reported inflation rates are low, then several kinds of costs also go lower. For example, the cost of tips, right? So of treasury, inflation protected securities, those go down. Or let's say the inflation adjustment for all the government workers, all that labor cost also goes down, relatively speaking. There might also be more demand for the currency, right? So other countries might be more willing to buy the US dollar as a reserve currency. Or companies might also very much pressure the government to report low inflation rates because companies also have to give out inflation-adjusted salaries. So the lower the number, the better it is for the large corporates as well. There are many ways to fudge that data, right? For example, to look at what is actually a representative basket of consumer goods. What are really substitute assets? When should we substitute something? What should be the weighting of different goods in the basket? And so really, when we look at property, we look at the net rental income after cost, and that's lower than even the official CPI. And the real inflation numbers are likely higher than that. That's not good. If you've got a dividend yield of 1.1%, that's lower than the CPI. That's not good. Nobody buys those things in order to cash flow. Everybody buys those things in the hope that there will be somebody that will pay more for this in the future. And that will only happen if credit continues to expand, if the US dollar continues to devalue at a sufficient rate. And so really, the idea of passive income is completely fake. Capital is really just another lever for our skills. All income is active. And if we know a particular market very well, if we know the property market very well, and we know this particular house is very cheap, or we know the crypto market very well, and we know this particular asset is likely going to outperform or underperform, then we can play this player versus player game, and we've got a lever. The more capital we have, the more we can take out of the market if we know what we're doing, if we are beating the market, if we are among the top skilled. But still, right, this is trying to beat the market. This is active income. This is learning faster than the average market participant. In the end, we still sell our time this way. It's active income. We don't sell our time for a fixed US dollar amount. We sell our time for a percent return. And of course, the more capital we have, the more the percent return in the end matters. And so what's the takeaway here? The takeaway is that you can't tell yourself that once I had XYZ dollars, I could retire. Instead, you should think that once I had XYZ dollars, I could lever my active income more. My active income would go higher. My hourly rate would go higher. I would earn more per month, per year, if I had more capital, if I also had the skills with the capital. And so what does this mean when the returns on capital are so low that they're even below the inflation rate, when we do not have any passive income, when it's just a lever on our active income? What it means is that we can just regard it as one of many tools, because there are many ways to improve active income. Having a lot of capital is only one of them, but we can lever our active income also by other people's time, right? We can hire people, or we can improve our own skills, right? We can learn technical skills, sell them for a higher hourly rate compared to what we now might have. There's many different ways to increase the hourly rate. There's many different ways to increase active income. But that's something for a different video. But still, try not to regard a certain US dollar amount as your ticket to freedom. It's just another lever on active income. There's really no such thing as passive income. If you just have your money stashed away in a diversified portfolio, you hedge yourself against monetary debasement to a degree. That debasement is dependent on credit creation though, and that credit creation can't go on forever. We're already relatively high in the cycle, right? Debt to GDP is very high. The Gini coefficient is relatively high. PE ratios are high. Returns on property relative to the value aren't very high. The dividend yields are extremely low. So it all shows us how there's a lot of capital and very little active income relative to the capital. And so there's already a lot of credit in the system, and that can't go on forever, right? We can't have a debt to GDP of say 1000%, because at that point the interest rate payments would be much, much higher than the tax income. So there is a certain breaking point. At some point people can't afford a mortgage anymore. If house prices were suddenly 10x of what they are today, nobody could buy a house anymore. And so credit can't expand. Credit is a result of how much we can lever up active operational income. So over the very, very long term, there has to be some kind of fixed ratio between the two, between how much capital there is versus how much cash flow there is. There is a limit to how much distortion the system can take. Now, if this is your first time over here, then feel free to, of course, subscribe. There are several videos like this in a playlist on this channel. So feel free to click on the channel, click on content and playlist, and feel free to also watch the other videos. I think this is now video number 10 or 11. Feel free to simply just binge watch if the content that you got from this video was helpful. Thanks again for watching. See you next time on YouTube, or potentially also see you in the premium membership. This is where I share how I personally manage my capital. A link to premium pops up here on the screen. See you next time. Cheers.